Good morning, ladies and gentlemen. Well, just as things get interesting, the site is still down and the scores are they are coming off quite rapidly, but unfortunately we can't display them. We have high hopes that we'll be able to do that next week and correct the corrupted database. I'm once again very sorry for this, but what can I do? I'm in the hands of the developers, and hopefully they'll sort it out next week. Having said that, things are changing rapidly, and let's see first of all what the bonds are telling us. The action in the yield curve is not in the 2s 10s. The 2s 10s are completely stable, and basically between this 98, 99 and 119 level. I will go with the break either way. I think the break is going to be down, and we do have these massive central bank meetings. But what seems to be happening is that the only parts of the yield curve that are moving is the belly, basically the 5-year area and the 10-year area. Everything else is completely stable. 2s to 30s completely stable, and everything else is moving, basically anticipating an announcement of the tapering of QE, whenever that happens, whether it happens in September or it happens in October or in November, I think is completely irrelevant. It will be coming at some stage, and it looks like it's coming exactly at a stage when the world economy is beginning to falter as a result of what is happening in China and the woes of the property sector there, which is a huge part of GDP. That is bound to be deflationary, I think, and that is why I think the only possibility, or the possibility with the largest probability and risk reward, is one of flattening. This flattening is very much evident in the 5s 30s. This is going to be a daily chart of the 5s 30s. As you can see, we have closed the week above this 109 to 105 area, and likelihood says that, we might piss around here for a couple of days, but after the Fed meeting I expect the direction of travel to be towards 81. That seems to be the path of least resistance. And if we look at the 10s 30s, the flattening is evident there too. I would have thought that 43 level is likely to be hit at some stage. I think this is a result exactly of what I've been saying about China and the woes there. There is massive demand, I would have thought, for duration instead of equity duration, bond duration, and that is pushing the 30s part. In fact, the only thing that is moving are the 5s and 10s. Basically, the belly of the curve is getting cheaper, anticipating QE whenever it happens. But the other parts, the 2s, basically are saying we're a long way away from tightening, and the 30s are saying, well, disinflation is happening. If we now enlarge the chart of the 5s, you can actually see that is the only thing that moved last week. 1, 2, 3, 4, 5, we closed up 1 or 2 basis points higher, and we are on the door of this 85, which is so important, because through 85 we will go all the way to 97. I don't expect that to happen next week, simply because I don't think the Fed's going to do anything. I think the Fed is going to try and soothe the market. If we now go on to 10s, you can see much the same behavior, and here we have this 139 level, which I think is going to be very, very important. Again, I don't think the market is going to bust through it by very much if it does, simply because I don't think there is going to be enough pressure. And if you look at the 30s, as stable as anything, right? I mean, 1, 2, 3, 4, 5 days, we closed exactly where we opened. There is very little pressure in the 30s. The 30s are more likely to come off towards this 176 level than to go higher in yield, simply because I would have thought there's pressure from the credit spreads and people are looking for duration in the bonds as opposed to in the equities. That bids the 30s, and the 30s seem to be stable to doing better, and while the 5s and the 10s are the ones that are suffering, and you're getting the movement in the yield curve. The yield curve is basically saying flattening, and that to me is a small period of risk off in equity assets. In Europe, much the same thing is evident. The pressure is on the 5s and the 10s, and especially in Germany. In periods such as this, you go and try and find some yield. So people are buying the continuation. There is a continuation of people buying Italy and selling Germany. Germany has its own political problems, and also the fact that inflation is likely to remain higher than anticipated, and people are just not interested in owning an asset at -60. That, even if they have to buy European bonds for regulatory reasons, they are likely to buy something with positive yield, because I think the ECB will continue to support those markets, and therefore those spreads are likely to continue. I would have thought the 5s, will continue to basically trade in a range. What did we do? We gave up 4 basis points. I would have thought somewhere around here, around the -57, 56 area is all you can hope for in the bubble. If we turn to the Bund, we can actually see that I think we are likely to touch this level around -24 and remain in a range there as well. The one thing that keeps on trading better is the spread between Italy and the bonds. You can see that it's come off down to 98 basis points. If we have a look at it on a 6-month basis, you can see how this 98 level is going to be absolutely key. If we can go through 98, I think that spread goes to 90, no problem whatsoever. But the pressure is all on Germany. It's hardly anything else is happening in any other market. And here we have the OAT. The OAT, can you get to 15? Yeah, probably, but it's going to be better supported than Germany, and that trade, I think, still continues for the next couple of weeks. The spread between Germany and the US keeps on coming in. This is getting to be quite interesting. I would have thought if next week we break this 159 area, we're going to go all the way down to 152, 153, and that is a massive support. Below there, and something big has changed. We'll have to figure out what. But it will be a sign of, I would have thought it'll be a sign of deflation, and everything that brings along, which is a period of risk off. I would have thought it's more likely to happen than not. And that is why I'm more negative on Germany than I am on any other European market or the US. The fact that the spreads between the US and Germany are continuing to come in, but the dollar, instead of being offered, is bid, that tells you that it's a liquidity problem, most likely, out there, that people are abandoning other currencies and seeking the safety of the dollar. Could it have something to do with China? Absolutely, could have something to do with China. And the trend here to me seems unmistakable on the weeklies. I think, trading in the 94s is more likely than not. If we have a look at the daily, purely the daily chart, I would have thought that once we break 93.63, we trade to up to 95.07 very, very quickly. But the pressure seems to be on a demand for dollars. Even though, as I said, the spreads between Germany and the US are compressing in terms of the yield spreads, but the dollar is still bid. This is a liquidity thing. This is a worry thing. This is a risk-off thing. And gold does not seem to like this little deflationary threat that we have out of China. Although the dollar is roughly bid, nothing extreme. We haven't really moved that much on the week, and the bonds are doing nothing. Gold is offered, and basically just can't even hold 1764 on a closing basis on the week. That to me says that, okay, we might have a couple of days of small rallies, but the trend at the moment is very much down. I don't think we can break this 1700 level very easily at the moment, but that seems to be the general direction of travel. I really, until things change and we can break above 1830, I really don't see any point in owning it, especially not during a deflationary phase. The thinking goes like this. The property sector is like something like 20-25% of the Chinese economy. If that's in trouble in general, you get a period of upstream and downstream weakness, i.e. Furniture, glass makers, whatever you want to call it. That is going to be a period in which prices come off. If prices come off, what's the point of owning gold? What's the bottom of gold? Who the hell knows? But there just doesn't seem to be a particularly good reason to own it at the moment. And that's all there is to it. Will a level like this, like 1600, be very attractive for the long term? Most probably. But in the meantime, absolutely no point in owning it. Let the market tell you where the bottom is going to be. Gold is weak against DBC, it's weak against SPY, it's even weak, it's weak against the bonds. It's weak against everything. I keep on saying I would have thought that DBC over the course of many months can get down to, the spread between DBC and gold over many months can get down to this 638 level. And that is where its fair value, gold will then be cheap. Basically, that's what I'm saying. If we look at what DBC did on the week, it tried the upside and failed. Basically, this is a doji. I would not be surprised to see it come off. If I'm overall bullish for the DBC gold spread, and I think that DBC is now likely to come off a little bit, back down to these levels around 1868, 1841, then I can't be bullish on gold. I think gold, the path of least resistance is definitely going to be down. There isn't a single spread that is supportive of gold. Even during a period of weakness in SPY, this is SPY over GLD, SPY is outperforming it. In a period of nothing really happening in bonds, bonds are outperforming it. ACWI, i.e. the world stock market, also outperforming it. So it's not a question of one particular stock market like SPY, it's a question of the world stock market. And while that is happening, that's going to take many, many weeks to correct and find a bottom. So I would have thought that for the rest of the year, most probably, gold is not going to be an asset which is going to be vastly in demand. Equities are going to be very interesting next week, and I want to start with this chart, which is SPY over EWJ, and for many weeks I've been saying that around this 6 area, that is where I expect the performance of SPY and Nikkei to start going back in sync. And basically whatever you see Nikkei do, that is what SPY can do as well. So next I want to go and have a look at Nikkei and tell you what I expect there, and that will reflect and match what I begin to expect for SPY. And here we have the Nikkei. As you can see, it got right to the level that I expected, 30,400 on the dailies, 30,200 on the weeklies, and just could never sustain trading above it. We've closed the week with some kind of a hanging man. Unless we get something very weird going on, I expect this slowly to come back towards 28,180, 28,335 on the dailies. And if we maintain the spread or start bouncing a little bit from 6, that tells you that the path of least resistance then for the SPY will be down a couple of percentage points, maybe 3 percentage points. But certainly I think that Nikkei is now wedded to SPY. The spread has come down enough. Those levels are, vastly above 6 were just unsustainable. So now these two, the SPY and the Nikkei, should trade much more in tandem. This whole move could get, negated by 50%, and that would allow SPY to come down. Let's start with the weekly chart of SPY, and it's a complete mess, so let's enlarge it. Or if I can, let me try again. For the first time in a long time, we've had 2 red candles. And basically the real weekly support, the first real weekly support, is 43.71. And below that, the really good support, where I really want to own them, is this 42.47, 42.32 area. Those are fantastic. That's a great support down here. And the first support, and I would have thought that by the time we, the Fed comes out and says something, odds are that we could trade this 43.71 area and bounce from it. You can see how many weeks we have traded above it. It's going to be very hard to break, and this support here, I don't think we're going to break this year, 42.47, 42.32. As if the Nikkei comes off a couple of percentage points, we could definitely come into this area, but I really don't see it much worse than that. Certainly not. I would have thought, a third week down, totally possible, but a fourth, and certainly through this area, 42.47, 42.32, I am selling a lot of puts struck around there in the short term. Volatility is high and they're giving you a wonderful price. This is my cleanest daily chart, and basically what it's saying is that we have a wonderful opportunity to trade these areas, but that the market will definitely at the moment hold them even if we get this deflationary wave. To me, it's very unlikely that we trade through 42.55 at any stage soon, whatever the Fed does. the likelihood of the Fed tapering right now are very low. What they are likely to say is that it's a data dependent taper, and that makes sense. Why not? All tapering, all QE, all Fed actions should be data dependent. But what that does, it allows the weakness of China to come through. You can see that we've had quite a few days down, 5 days of a red candle, then one up, and then, we're breaking down again. I wouldn't be surprised to see if it opened below this 44.23 level. And that allows some backing and filling. We still have gaps here at around the 43.25 area. Certainly on a daily basis we can come down into the 43s without any problem, but I don't think that that is anything but the market readjusting in a very weak, don't forget that this is a very, very weak phase in the year, where seasonally these are going to be the two worst weeks of the year. So you would expect some weakness, but I think if we see 42.55, what a great level to buy calls. I keep on looking at these tech spreads, and basically, unless the NQ leads us down, there's very little likelihood that we can have a complete nightmare in the SPY all by itself. If you have a look at XLK over SPY, I mean, we are just hanging in there, just below all-time highs. The market really needs to come down towards 34 to give some weakness in the whole general XLK. If we look at NDX over SPY, we're so close to all-time highs. That needs to come down quite decisively to these kind of levels to enable SPY to come down into the low 4300s even. So NQ is again going to be critical. And here we have NQ, which just like SPY had two candles down, two red candles. The critical level, and this is still so very close to all-time highs, is 15,111 on the weeklies, and on the 195-minute chart it's 15,184, down to 14,992. Unless we can break this area of support and demand, I really don't see the SPY being able to do much better than another 2% down. NQ is just not allowing it. The spread, unless the spread really comes down against both SPX and XLK and all the spreads I've just shown you, we need a big move down in NQ to even allow the possibility of very much at all in SPX, and I just don't see it. Could this be an ABC and we come down into here? Absolutely. But what does that do? That only allows XPX to go down another 60, 80, 2% basically. So, I really cannot get that bearish on the stock markets. I'm more looking for levels to buy, because this China thing, yes, it's important, but it seems to me that it's becoming in the price. I don't think we're in for a period like this. I think we are much more in a period of support, finding where the decent support is, and then for another move up in the fourth quarter. The one market which tells me to keep an open mind for a slightly bigger move down in equities is actually the VIX. It's closed for a second week in a row But it's noticeable that, we've closed lower in SPX and NDX, and we haven't closed higher in volatility. So it seems to be still well behaved. To me, 2251 now becomes an area of big importance. If we start trading through there, I will allow for the possibility of a little bit more in SPX. But I think, it's relatively well behaved. Second week that we haven't even got there, and the market is orderly. It just says that, that there is a small period of risk off going on, but it's not all that significant in the longer term. Why don't I think that we are in for big trouble in the stock market? Well, XLY, XLP is one very, very good reason. This is what XLY, XLP did during a period of risk off in, when we had the coronavirus panic. XLY, XLP is very orderly. We are not going to get a recession. We're not going to get much lower prices unless we get a recession, and we're not going to get a recession unless XLY, XLP starts collapsing. It's, it's been where it's been since the beginning, what is this? This is the beginning of 21, the first few months of 21. So basically it's saying that at worst, we go a few percentage point lower, but that this is not it's not signaling an imminent recession of any kind. And Europe is basically saying the same. It keeps on failing at these high levels, about 4,200. But really, what are you looking for? You're looking at the stocks at fantastic support around 39.86, and you're looking at great support in the DAX, 14,800 area, with these 200-day moving averages coming up very, very quickly. So all these charts that I'm looking at are saying that weakness to significant levels that I've indicated before and are on the summary sheet is a buying opportunity. And onto the summary sheet. I've changed some levels, especially in the bonds. I've tightened them up considerably given what is going to transpire this week with the Fed and the Bank of England and the Bank of Switzerland, etc., etc., etc. I really don't think it's going to make much difference. I think the tapering is going to be data dependent, and the data dependency is just that. We're going to find out month by month with unemployment and inflation figures where we stand. Basically no change. I would have thought that continues to flatten the yield curve. I think the 2s and 5s area are more likely to go up than down, simply because of the constant threat of tapering, while the bonds do nothing or do slightly better, i.e. the longer end. All these are the levels. I would have thought the spread between 10-year and US, Germany and US, could keep on coming in. Germany has its own problems, and I would have thought this BTP Bund has a great chance of breaking 98. And if it does, it'll go, another 7 to 10 basis points without any trouble. To me, the bubbles and the bunds are an avoid rather than a sell, and it's as simple as that. I've changed all the levels in SPX. I doubt very much that we trade below 43.18, but in any case, it's going to be absolutely dependent on what NQ does. Unless NQ leads on the downside, SPX is going to be orderly, and it's going to find support at very, very interesting levels for the long term. Everything else, gold, I just don't see any point in owning it. The moves are going to be to the downside, I believe, because unless we see some real inflation and the central banks not acting on it for the time being, it's a deflationary period rather than an inflationary period with what is going on in China. and gold, I believe, has no friends. Thank you very much indeed, and tweet you on Monday.